Today, place your bets on Fed rate hikes continuing. Hello again, it's Martin North from Digital Finance Analytics, with this post covering finance and property news with a distinctively Australian flavour. Well, US stocks ended down on Wednesday, pairing some of the previous session's strong gains, with tech-focused shares leading the way lower. Alphabet was the biggest drag on the S&P 500 and Nasdaq. Its shares sank 7.7% after its new AI chatbot Bard delivered an incorrect answer in an online advertisement. But more significantly, a shift in sentiment on Federal Reserve policy is emerging in interest rate options, where several big wagers on the central bank's benchmark rate reaching 6%, nearly a percentage point higher than the current consensus, have popped up this week. The thinking behind them flies in the face of what has been an article of faith over the past 2 months that the Fed, after raising rates 8 times in the past year, is near the end of its tightening cycle. Already, rates are high enough to cause a recession that will require the central bank to reverse course this year, the thinking goes. But strong January employment data released on Friday challenged that thesis, and comments by Fed officials this week have eroded it further. Now, a pause after just 1 or 2 more rate hikes is not looking like such a done deal. On Tuesday, a trader amassed a large position in options that would make $135 million if the central bank keeps tightening until September. Buying of the same structure continued on Wednesday, alongside similar bets expressed in different ways. Preliminary open interest data from the Chicago Mercantile Exchange confirmed the $18 million wager placed on Tuesday in secured overnight financing rate options set to expire in September, targeting a 6% benchmark rate. That's almost a full percentage point more than the 5.1% level for that month currently priced into interest rate swaps. Swaps pricing at peak rate are around 5.2%. That's near central banks' own projections. Buying of the position was ongoing throughout Tuesday's session, though it ramped up significantly in the afternoon via block trades, after Fed Chair Jerome Powell suggested the latest monthly job numbers may necessitate more tightening than previously anticipated. The trade would break even at a policy rate of around 5.6% and makes $60 million should the Fed raise it to 5.8%. It's the latest in a series of big wagers that show no signs of letting up, even as the Fed has slowed down a tightening cycle that has been the fastest since the early 1980s. Last month, SOFR option bets made CME Group history, recording the biggest inflow on record into any product traded on the exchange, and it marks a sharp turnaround from the big theme in the market last week before the strong jobs data came out. Traders were betting on sharp rate cuts in the second half of 2023. Overnight index swaps are still pricing for easing later this year, and at the moment they show the Fed's benchmark peaking at around 5.17% in July, before ending 2023 at around 4.84%, implying about 32 basis points of cuts. But that's way down from 45 basis points as at Thursday's close. Investors are already looking ahead to what new interest rate projections the central bank's so-called dot plot, to be published after its policy meeting in March, may show, now that markets are aligned with the latest set of projections published back in December. Federal Reserve Chair Jerome Powell said on Tuesday that it will take a while to bring inflation in check, though he acknowledged disinflationary forces were at work after successive rate hikes last year. Of course, last week the Fed raised rates by another 0.25 percentage point. Futures traders are forecasting another 0.25 point hike in March and another in May, pushing the benchmark rate above 5%. And Fed officials have also forecast the terminal rate to reach above 5%. Several Fed officials were out this week as well, including New York Fed President John Williams, who appeared at a conference, and he said financial conditions look to be in line with what the policymakers want to see. And he said during that Wall Street event that the December outlook still seems a very reasonable view of what we'll need to do this year. But he said The Fed needs to do more to cool inflation, though added that the recent shift in market bets for 2 further rate hikes was still a reasonable view. Whether that view holds until March will depend on inflation data to be released between now and then, according to Jason England, a global bond portfolio manager at Janus Henderson. The market has come back in line with where the Fed is right now, with their peak terminal rate. The question is, do they revise the dots up? England said. And adding to the cautious mood, Fed officials on Wednesday said more interest rate rises are on the cards as the US central bank moves ahead with efforts to control inflation. None hinted, though, that January's strong jobs report could necessarily drive more aggressive policy actions. Fed Governor Christopher Waller said inflation seems poised to continue slowing this year, but the US central bank's battle to reach its 2% target might be a long fight, with monetary policy kept tighter for longer than anticipated. Waller warned of a long fight to curb inflation that would require interest rates higher for longer than some are currently expecting. Stocks rallied on Tuesday following Fed Chair Jerome Powell's session before the Economic Club of Washington, where he said interest rates might need to move higher than expected if the US economy remains strong, but said he felt a process of disinflation is underway. After this kind of run and a move to a valuation certainly in the richer camp, you need to have more evidence to keep the market climbing higher, said Quincy Crosby, Chief Global Strategist at LPR Financial. The Nasdaq remains about 14% up for the year to date. So the Dow Jones Industrial Average fell 0.61% to 33,949. The S&P 500 lost 1.1% to 4,117, and the Nasdaq Composite dropped 1.68% to 11,910. Investors have been concerned about how aggressive the Fed's actions may be this year, following those surprisingly strong US job reports on Friday. They've also been concerned about the mixed reports from US companies this earnings season, with results in for more than half of the S&P 500 companies. Earnings are still expected to have declined year over year in the fourth quarter of 2022. After the closing bell, shares of entertainment company Walt Disney were up 1.6% following the release of its quarterly results. The stock ended the regular session up just 0.1%. Investors were also digesting comments from President Joe Biden's State of the Union address late on Tuesday, when he supported calls to tax corporate share buybacks. CVS Health Corp ended the session up 3.5% after its $9.5 billion cash buyout offer for Oak Street Health. Oak Street Health rose 4.6%. And Google held that event to promote the launch of its new artificial intelligence chatbot, Bard, but the AI chatbot reportedly delivered inaccurate answers in an online advertisement just ahead of the event. In response to the glitch, Google said that it will use external feedback and its own testing to ensure Bard's responses met a high bar for quality, safety, and groundedness in real-world information. Actually, sentiment on big tech was soured further by ongoing remarks from Fed members who continue to talk up the long road ahead to stable inflation that will likely require further rate hikes. Apple, Amazon, and Meta were all in the red, but Microsoft, still riding high on optimism over its plans to integrate ChatGPT into its search engine Bing, as well as other products, was the relative outperformer, closing just below the flat line. On the earnings front, meanwhile, Uber Technologies was the standout performer, closing up more than 5% after the ride-hailing company reported a surprise fourth-quarter profit and upbeat guidance. This was a major step in the right direction for Uber, with a profitable growth story into 2023 and beyond, Wedbush said, as it lifted its price target on the stock to $40 from $38 a share. Under Armour reported quarterly results that beat on both the top and bottom lines, but its shares fell 8% as promotional activity is expected to continue to weigh on gross margins, just as inventories continue to grow. And energy, meanwhile, was pressurized by a slide in APA Corporation, EQT Corporation, and Chevron, though higher oil prices underpinned by a stronger dollar helped keep losses in check. In fact, oil rose for a third straight day on Wednesday. A weaker US currency makes dollar-denominated oil cheaper for buyers holding other currencies. The reduction in risk appetite that had spun largely off Fed Chair Powell's comments yesterday applies equally to industrial commodities such as oil in providing a significant headwind against further major price advances, said Jim Ritterbusch, president of Ritterbusch and Associates. Brent crude settled at $1.4 or 1.7% to 85.09, while WTI settled at 1.7% to 78.47. Investors hope less aggressive US interest rate increases will help the world's biggest economy dodge a sharp economic downturn or recession that would hit oil demand. China's ending of COVID-19 curbs, meanwhile, is also expected to support demand for fuel. A looming oil demand surge together with lackluster global supply growth will ensure that the oil balance tightens over the coming months, said Stephen Brennock of oil broker PVM. And on supply, OPEC and its allies, OPEC Plus, last week decided to keep output curbs in place, and an Iranian official on Wednesday said the group is likely to stick with current policy at its next meeting. The earthquake that struck Turkey and Syria on Monday stopped crude oil flows from Iraq and Azerbaijan out of the Turkish port of Ceyhan. BP Azerbaijan has declared force majeure on Azeri crude shipments from the port. Iraq's pipeline to Ceyhan resumed flows on Tuesday. And US Energy Information Administration data show that US oil production rose last week to the highest level since April 2020, however, and that may help to limit oil's gains. There are some people out there definitely throwing money at the production side of the business. That was bearish for the market, said Bob Yoga, Director of Energy Futures at Mizzou. Crude inventories rose by 2.4 million barrels in the week ended February the 3rd to 455.1 million barrels, compared with analyst expectations of Reuters poll for a 2.5 million barrel rise. So there's still a lot of play here, of course, but this change of trajectory in interest rate expectations relating to Fed action is significant, as is the weaker results from companies reporting. Put the two together, and the recession barometer probably ticked up a notch, and that means we're going to see higher rates, but potentially also weaker economic growth, which equals lower stock prices ahead. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.